Welcome to American Dreams, Keys to Success, with your host, Alan Olson.
Welcome back. We're here today with David Waitrowicz of the Waitrowicz Group, a private wealth manager with Merrill Lynch. Welcome to today's show.
Thank you. It's a pleasure.
So, David, give us some background of how you got into wealth management, type of clients.
Sure. This is my 30th year now in the financial advisory practice. Proudly, I might add. I think the work that we do is very important, and we try not to take ourselves too seriously, but we take what we do seriously. The types of clients we work with have been very successful in the business world financially, and they have an opportunity to do something unique in their lives and taking their wealth and, of course, living comfortably themselves, but also how do they want to positively impact their family? How do they want to positively impact the organizations, the causes, the charities that they feel strongly about? So it's a lot of fun. So for 30 years, all here in the Silicon Valley, have clearly witnessed a tremendous amount of growth with the technology boom and internet. It's just been extraordinary. And so we've watched clients create companies, sell them, buy new ones. It's been fun. It's been a lot of fun. 30
years in the history of the Valley has been tremendous. From where we come back in 1982.
That's right.
So as we talk about the concept of wealth management for our listeners, what exactly is that?
I think that's a good question. I think when you look at wealth management, I mean, some people think of it as financial planning. Some people think of it as just investing. I think it's a combination of things. I think what it really boils down to is how do you want to use your wealth to make a positive impact in your own life, in the lives of your family, and the things you care about. So really that boils down to where really what I think the most important step in the whole process is, which is the financial plan. Most people don't have a plan. Unfortunately, I mean, I can understand why. They spend more time planning for their vacation than they do their own finances on an annual basis. But one has a lot more longer impact than the other, obviously, and that is long term. What are your goals? What are you trying to accomplish? More importantly, though, what are the challenges or the dangers that stand in the way of you accomplishing your goals? Those are the things that go into wealth management, in my view, and also financial planning. And then your investment portfolio is structured from there.
So how does a person get wealthy, David? Let's say I want to come to you and tell me, how do I create this?
Most of our clients have created their wealth as a result of entrepreneurial activities, running a business, a project, real estate development, whatever it happens to be. And then what happens along the way, and of course it takes people years to do that. It doesn't all of a sudden happen overnight, although sometimes it does, I suppose. But most of the time, in my experience, it takes people years to do it. We work with both private companies and people who've started public companies. But then they decide, okay, I want to take some of that wealth off the table. I call that entrepreneurial wealth. They want to then move the wealth or some of it to what we'll call wealth preservation, which is, now that I've made it, I don't want to lose it. And that's where I think is, how do you stay wealthy? It's hard to stay wealthy. It's not easy. It's one thing to make it. It's a whole other one to keep it.
I think it's true. It's, as a person accumulates wealth, obviously there's a risk factor involved. What would you say the greatest or the biggest mistake investors make?
I think that you've hit it right on the head. With most things in life, one bad thing can wipe out an awful lot of good things. And I think what people do is, one, they don't have a plan. Two is they don't look at their investing through what I'll call the glasses or from the perspective of risk management. Returns take care of themselves. It's the risk somebody has to be conscious of. Mm-hmm. And then I think the third thing is they take too short-term of a view. Alan, when I got into the financial advisory business in 1982, and I'm going to say this so you realize I don't make a mistake with it, the S&P 500 was 125.
Wow.
Today it's 1,400. And we've had a lot of weird things that have happened in the last 30 years. We all know what they are: political events, worldwide events, terrible things. But American capitalism works, and it keeps building and growing. And I think it's important for people to look at this long term. I don't think we as a world are going back to the dark ages, in spite of what we read in the media about all the problems. Yes, we have problems, but they're not insurmountable. And I think people need to realize that, looking long term. And I think the big issue that people have to concern themselves with, quite frankly, is maintaining purchasing power, inflation. That's it.
Now, David, for the listeners, there's a lot of wealth managers out there. Okay, but how do you differentiate yourself, from the next guy?
Well, thanks for the question. I appreciate that. I think the approach that we take, the conservative style certainly, but also the discipline factor. I try to convince clients that they are like an endowment. So if you look at the college endowments, Stanford, Harvard, University of California, what you find is that they've been very good investors. Why? They take a long-term approach. They have a disciplined process. They don't invest in fads. They're very careful. And we try to suggest to people they should follow those same rules. God willing, we're all going to be on this earth a long time. Our kids are going to be on this earth a long time. That starts to look like an endowment. Endowment's around for a long, long time. How can we invest our money for the long term? So we have an approach we call the endowment approach to investing. Broad diversification, risk management. But most importantly, it's the discipline and the planning that leads to that investment. So I think that's the approach that we take.
Very good. I'm visiting here today with David Waitrevich of the Waitrevich Group, a private wealth manager with Merrill Lynch. Stay tuned. We'll be right back after these messages.
Protecting your family's health and welfare is a sacred trust. At Greenstein Rogoff Olson Company, we know that sound financial planning will protect them now and in the future. We're certified public accountants with tax services for the highly successful. For your business and your family, call GrowCo.
Greenstein Rogoff Olson Company will help you manage your financial affairs so you can focus on what's really important in life.
GrowCo, helping you along the way.
Apple pie, baseball, and now here's All-American Alan Olson.
Welcome back. We've been visiting today with David Waitrevich of the Waitrevich Group, a private wealth manager with Merrill Lynch. And David has some 32 years in the industry, so going all the way back to 1982, he's seen a lot happen here in the Valley. David, I want to move into picking up where we left off, talking about this financial plan. Mm-hmm. You mentioned before that people fail to accumulate wealth. Most of the time, their biggest mistake is that they fail to do so because they really didn't have a plan in place. Mm-hmm. So what is a financial plan, and why is it important for somebody to have one?
Sure. So I think the first idea is that with a financial plan is, what are you trying to accomplish? It doesn't necessarily mean you're going to hit it, but at least you're going to be going in the right direction. And then I think the second component to it is, as I mentioned earlier, what are the dangers or the problems that would stand in the way? I remember reading a story on Dwight Eisenhower after D-Day, and we'd already now had our beachhead on Normandy, and the reporter said, "Gee, that plan! What a great plan!" He said, The plan went out the window the minute we hit the beach. Nothing worked the way it was supposed to. The planning was critical. It made us think about what happens if this doesn't work this way. What are we going to do? And that's what I think financial plans do. Sitting down, looking at a wealth management structure of sitting there saying, okay, so what are some of the contingencies we should think about? And we deal with a lot of people that have private companies, and they have unique situations. Do I pass the business on? Do I sell it? Do I buy new businesses? Do I keep it just the way it is? That's also the process of a financial plan and trying to ascertain, so I've got these important assets. How do I take care of my children? And how do I bring them into the business? It's really what it really is customized to each and every individual, and it boils down to what they're trying to accomplish.
It's interesting when you talk about a plan, on our timeline of life, we only go through each stage once for 20, 30, 40. And what you just said really makes sense. People that move a certain direction with intention are more apt to get there than those who float and said, I'm just going to take care of what's in front of me today.
Yep.
So when we talk about a plan, if I understood you right, it's not just about investments, but it's about your life.
It has to be about your life. I mean, it has to connect back in, because if it's just about investments, it's kind of numbers, and that's fine. But what does it mean to you? What is it? For instance, I sat down with somebody yesterday and he said, David, he said, I am not going to have a situation where my grandchildren are going to get student loans to go to college. Not that there's anything wrong with student loans, but he said, we have the wealth to do that. What's the best way for me to financially support my grandchildren to go to college? That's a financial plan. Others might say, well, I want to have a vacation home in Lake Tahoe. That's part of a financial plan. It's unique to every individual, but also you have to ask yourself the modeling, well, what does this mean to me if I were to buy a home in Lake Tahoe as an example? And what does that do to my cash flow? What does it do to my tax situation? How does it impact my long-term investments? So typically in our practice, what we're doing is we're modeling that out for clients so that they understand the numbers before they make the decision.
So you're really involved intimately with a person.
We want to make sure we understand. The old saying is walk in their shoes. We want to make sure we understand where they're coming from in order to create the plan and the strategy to go forward. I mean, the only rational way to measure your own success ought to be based upon your own scorecard, not what the markets are doing. I mean, I've been doing this now for 30 years, as you said, and I've been with some people who've passed away and clients of mine have passed away. I haven't heard one yet say, boy, my life was great. I earned a return better than the S&P 500. It doesn't work that way. It's where do you get to go with who, do what, where? And so it's wealth as a tool.
How do you, when markets crash or a lot of volatility, how do you handle that? Because you're experiencing yourself together with them.
Yeah, and I think that's the part that we kind of touched on a second ago, where we talked about that really helping people understand taking the long term. But when you're going through in the short run, it doesn't make you feel any better. We model out scenarios for people so they can see what their portfolio would look like. Behavior dictates results, and we all kind of know certain things, but it's our behavior that creates the results. So what I really am in a lot of ways is a behavior coach, and kind of helping people understand what to expect. The hope is their behavior will be different when we hit the moment of truth, and they'll say, yep, I know we got to think longer term. But having, your cash reserves too, so you don't have to upset your portfolio in those moments. The one thing I know for sure, in the next 20 years, there will be more down markets. But the interesting thing is, unless the American capital system is indeed broke, I don't believe it is, the upward trend is permanent. The downward trends are temporary.
Very good. I'm visiting here today with David Waitrowicz of the Waitrowicz Group, a private wealth manager with Merrill Lynch. We'll be right back after these messages and hear more from David.
He's the world's most trustworthy man. Tax filing deadlines are scheduled around his vacation calendar. The IRS agent who audited his client apologized.
I don't always advise people on their taxes, but when I do, I save them every penny legally possible.
GROCO CPAs and Advisors.
Come to GROCO and stay wealthy, my friend.
Apple pie, baseball, and now here's All-American Alan Olson.
Welcome back. We're visiting today with David Waitrowicz, a private wealth manager with Merrill Lynch. And before the break, we had talked about the importance of developing a plan. And, but in this day and age, with the world in constant change, individuals coming to you, David, and they're saying, what are the things that they should be looking for? As a forecast into the future. In other words, if I came to you today, how would you treat me? And maybe we can elaborate on
Sure. So I think the first step is, as we talked about earlier, is to really understand what it is you're trying to accomplish and what those problems or dangers or issues that might be that stand in the way. And then the next step then would be to say, all right, based upon your objectives, what's the appropriate investment strategy and allocation of your money to accomplish those? Now, we have to take into consideration risk, because it's not that we kind of sit there and say, well, we're going to look at risk because it's going to do something to us. It's really how you're going to behave in those moments of the down markets. We know that the longer the term the person invests, the better chance they have of achieving their objectives. But yet we get frightened out by events in the marketplace. So we need to create an allocation then that you're comfortable with, that both gets you to your goals, but at the same time you can live with during those down periods. And so again, we're going to kind of model it out and, for lack of a better term, kind of do some risk scenarios that say, can you live with this? Can you live with this? Kind of taking you through various levels of what I'll call pain, so that you can kind of say, yep, I can see that downside. I've been in a lot of people's offices. Have yet to have somebody say to me, that upside volatility is killing me. It's always the downside volatility that beats people up. And so trying to understand what that would look like and then being able to manage behavior is in my view, is a way to success. But I think the biggest risk that stands in front of people today is not understanding what inflation does to their money.
That's interesting. So when we address inflation, first of all, I want to go back for the listener's sake. First of all, I'm talking about allocation.
Mm-hmm.
Okay, so let's say that I got some cash, I got some stocks. Do you go beyond that and look at a rental property or personal residence and take everything into the same bucket? And
thank you for mentioning that, because there's really two ways we look at it. We try to suggest to people that they're better off categorizing their wealth. They have their entrepreneurial activities, their businesses, maybe their real estate developments, their projects. We really don't count those in the wealth preservation portfolio. The wealth preservation portfolio is broadly diverse. It's run like an endowment would run their portfolio. And we don't want anything from the entrepreneurial side to essentially infect or create any problems on the wealth preservation. Wealth preservation side is there to create serenity. I want to be able to make sure I've got money that I know is going to be there. I've taken it out of the entrepreneurial side. I've harvested it. Now I just don't want to have to get wealthy twice or recreate this portfolio twice. So how do I build wealth over time, preserve that capital? So we will look at real estate in there, but it has to be broadly diversified. We will look at maybe private business opportunities, but again, it has to be broadly diversified. It can't be kind of a concentrated investment, because concentrated investments have, because they're in one thing, an awful lot of risk. High reward, high risk. This portfolio is totally different. And it's there to be able to create that serenity that I talked about. And it allows people freedom to be able to say, okay, I know I have that taken care of in my life. Now I can go do all these other things, whether it be from a philanthropic perspective or be from an entrepreneurial point of view. There he gives them that freedom and that sense of security to go do it.
So I want to roll back on the topic of inflation.
Mm-hmm.
So people are going to the stores today. They're seeing the prices of food. They're looking at the price of gas at the pump, and they're hearing on the news, there's no inflation.
Yeah. Amazing, right?
So when a person's coming to you and they're saying, David, what's going on out there? And what does that mean to me personally with my money and with my wealth?
Two things I would say to that. One is, a few years ago, and I'm not a conspiracy theorist, so we'll just take that right off the table to begin with, but the government said we're going to calculate the consumer price index X food and energy, meaning they don't include food and energy in the consumer price index. Yet, as I think we all know, that's stuff that we buy every day. And so you're right. The prices of those things have gone up dramatically. What I think is interesting to note is, even at a 3% inflation rate, which is just about what the historical inflation rate has been over, let's say, the last 50 to 75 years, what costs you $1 today is going to cost you almost $2 in 20 years. So if your portfolio isn't going to double your income in 20 years, you've lost purchasing power and you've gotten poorer. Typically, historically, not always, bonds don't do that. They do not create the return premium above inflation. Equities or owning something does. So, for instance, if you were to look back 1982 till now, if you just took the dividend on the S&P 500, it's gone up by a factor of 5. The consumer price index, as a measure of inflation, it's gone up about 1.5 times. So if you lived off the dividend, your income's gone up almost 5 times. Your cost of living has gone up 1.5. That's pretty good. You like that.
That's a great statistic.
Yep. And so I think people need to realize when it comes to inflation that there's ways to get around it. And they've got to be very conscious of this as they allocate their assets.
So in another way said, if I'm the person that's really risk averse, and if I just leave my money in cash and I'm earning less than a 1% interest,
you're basically taking a real loss, meaning after inflation, after taxes, maybe as much as 2 or 3% of real loss on that. Your money's not maintaining purchasing power, and that is not good long term. That's how wealth gets eroded.
So when you go into the wealth plan, do you ever get into taxes?
We do. Because if you think about the second thing, or first thing for us, is there's really 3 ways that wealth is lost. One is you make a big mistake, and that usually can be satisfied by, let's call it, broad diversification. The way I try to explain to clients is say, you know what, manage your portfolio in a way so that you don't ever make a killing. Manage your portfolio in such a way where you don't get killed if things go wrong. So broadly diverse. Second thing, we talked about inflation, that erodes purchasing power. The third is taxes. The difference with today's tax rates, the difference between a long-term capital gain and ordinary income, I mean, you know as well as I do, is 20 full percentage points at the upper bracket. That is enormous. 15% federal versus 35. And some people think it's only going to go higher. So the idea is that you have to be conscious of how your money's invested in ways to create returns on an after-tax basis. And that's something we pay a lot of attention to.
I'm visiting here today with David Waitrowicz of the Waitrowicz Group, a private wealth manager with Merrill Lynch. David, if somebody wanted to contact you, how do they do so?
Thank you. I appreciate that. I can be reached through my office. My number, 415-288-2559. I'm in San Francisco, and if any of your listeners have some questions, encourage them to give us a call. Again, that 415-288-2559.
Very good. David, thank you for being on today's show.
Thank you, Alan. Appreciate it.
We'll be right back after these messages.
Discovering your keys to success. This is American Dreams on AM 1220 KDOW.